Now let's have a word about the quality ratios. In algorithmic trading, it's not enough to simply design a strategy and let it run. And when we are backtesting a strategy, it's crucial to evaluate the performance and looking from all the different perspectives that you can before you decide on the strategy and try to deploy it on a live market, trading with real money. And this is where backtest quality ratios come into play. These ratios, they help us understand the risk-adjusted performance of our trading strategies. Today we'll be diving deep into 3 such ratios: the Sharpe ratio, the Sortino, and the Kalmar ratio. The first ratio we're going to talk about is the Sharpe ratio. It measures the performance of an investment compared to a risk-free asset after adjusting for its risk. It's calculated as the average return earned in excess of the risk-free rate per unit of volatility or total risk. So the formula, or the easiest way to actually understand this, is to look at the formula. The Sharpe ratio is equal to the portfolio returns, so the current strategy returns, minus the risk-free returns, so our baseline returns, divided by the standard deviation of the portfolio returns, actually, of our current strategy that we are testing. So we're dividing this, the difference of our returns with the risk-free returns, and we're dividing it by the standard deviation, so the fluctuation of our portfolio returns. And this is very important to understand. In this equation, the portfolio returns are the gains that you've achieved from your strategy. The risk-free returns are what you could have earned from a risk-free investment like a US Treasury bill or anything else. And the standard deviation in the denominator, it's the standard deviation of the portfolio returns, which is the measure of the investment's volatility. A higher Sharpe ratio indicates that the returns have been higher for a given level of risk. However, it's important to note that the Sharpe ratio assumes that the returns are normally distributed, which is not always the case in financial markets. It also treats all volatility as equal, whether it's upside volatility or downside volatility. And looking back to the formula, to have a high Sharpe ratio, we need to have a high portfolio returns. So obviously our strategy should have high returns, which makes sense. And we need to have a big difference. So these returns should exceed by far the risk-free returns. So we need to perform better than a baseline. So far, all makes sense. And we're dividing by the standard deviation of our portfolio returns. So we're dividing by how much this return is going to fluctuate over the time that we are trading or we are backtesting our strategy. So to get the maximum Sharpe ratio, we need to have steady returns. So we need to have large returns, but also a very small standard deviation. We shouldn't have highly fluctuating or volatile returns. Otherwise, we would have a high denominator and it's going to decrease our Sharpe ratio. I like the idea. It makes total sense. We need to have steady returns and they need to be large enough to cover or to exceed the risk-free returns. The second ratio we will talk about is the Sortino ratio. This is a modification of the Sharpe ratio. It differentiates harmful volatility from total overall volatility by using the asset standard deviation of negative portfolio returns, downside deviation, instead of the total standard deviation of portfolio returns. This means it only penalizes negative volatility and not the positive volatility. And that's good to know because in the previous one, the Sharpe ratio, the volatility in the denominator, the standard deviation below, you can think of it as the standard deviation of our equity at different times. If you have a jump up, which is a positive thing, the Sharpe ratio is going to decrease because this is going to increase the standard deviation. This is where the Sharpe ratio doesn't distinguish between positive volatility and negative volatility. And the Sortino ratio will correct this problem. The formula is the following. The Sortino ratio is equal to the actual or expected portfolio return minus the risk-free return divided by the standard deviation of the downside return. So we're only taking the downside in the standard deviation. In this equation, the actual or expected portfolio return is the return achieved or expected from the trading strategy we are testing, and the risk-free rate is the return of a risk-free investment, and the standard deviation of the downside is a measure of the negative volatility. So it's only when your equity jumps down and not when the equity is volatile in the uptrend or in the positive direction. So by focusing on downside deviation, the Sortino ratio provides a more targeted measure than the Sharpe ratio. This can be useful in scenarios where we're more concerned about large losses than large gains. The third ratio we will be talking about here is the Kalmar ratio. This is a comparison of the average annual compounded rate of return and the maximum drawdown risk of commodity trading advisors and hedge funds. So the maximum drawdown is the largest peak to drop in the value of a portfolio. The formula of the Kalmar ratio is the following. It's equal to the annualized portfolio return divided by the maximum drawdown. Very simple, but very useful as well. So in this equation, the annualized portfolio return is the return of a portfolio if the returns were compounded annually, and the maximum drawdown is the largest drop in the portfolio's value over the specified time period. The time frame is typically set to 36 months. Higher Kalmar ratio indicates that the investment had performed better on a risk-adjusted basis. However, the Kalmar ratio should not be used in isolation. It's best used in conjunction with other measures like the Sharpe and the Sortino that we have just explained. So to provide kind of a holistic view of the investment's performance. So in conclusion, there is no perfect ratio. We have to use these three in conjunction. They are powerful together and they can help you evaluate the quality of your backtests. And it's good to keep in mind and remember that these ratios have their limitations. For example, the Sharpe ratio assumes that the returns are normally distributed and treats all volatility as equal, while the Sortino only considers downside volatility, and the Kalmar ratio is sensitive to the time period or the period of time chosen for the maximum drawdown. So therefore, they should not be used in isolation, but rather as a part of a comprehensive strategy evaluation framework where we can consider various aspects of performance, the win rate, the drawdown, and any other performance indicators that you can inject into your testing strategy. So it's also crucial to use historical data that matches the investment duration to avoid distortions in these ratios. Now we are ready to start building our prototype trading strategy and use the so far learned knowledge in this course to improve and optimize our trading indicators for this. In the next video, we will use Python and all what we have learned so far to build a profitable trading strategy, optimize it and backtest it, evaluating its performance. You can use this strategy as a starting point for your algorithmic trading or future algorithmic systems. We will go through the code in detail, line by line. I'll also load it with necessary trading functions and indicators that you can recycle and use later on in your programs. The Jupyter Notebook file is downloadable from the resources of the next video, so you can download it and use it to start building your own trading systems. Hi, and welcome back. Now it's time we start building our own trading strategy. So in the coming videos, we will describe the details of a typical trading system. We'll go through the different steps and explain our entry and exit signals. We will also go through the detailed Python code description that you can download from the resources section of these videos. You can use this strategy as a starting point where you can copy and paste parts of the code to build your future trading system. And if anything is missing, you can simply get inspired by how we proceeded in the Python Jupyter Notebook file to build your custom indicators and your custom entry and exit signals. Then we will backtest the strategy on historical data, which will allow us to evaluate the results and if the strategy is fit to be deployed for live trading on the market. So the example strategy is quite simple. What we are using in these videos now is really a simple strategy. I'm using the daily time frame for the Bitcoin US dollar exchange prices. We can start with the previously defined checklist to build our algorithmic trading system. So first of all, we need indicators and entry signal. If you remember in the course, we defined this as detecting the trend and the entry signals. In this strategy, we don't need the trend. It's not a trend-reliant strategy. So we just need to identify support and resistance levels. And we're looking for a rejection candle or a rejection pattern that's happening very close to those key levels. In this example here, looking at the bottom support level, we notice that we have a strong rejection candle happening right above the key level, and all the previous candles are above this level. This is a very important point that we need to include in our Python code. So prices going down reaches a support level, and we have a rejection candle. This will be our entry signal. And as you can see, the purple point in the chart is the real signal generated by the algorithm we are building right now, and that I have already tested to verify these signals. Now, for the rest of the strategy, meaning the exit signal and the lot sizing, we have so many approaches to choose from. So we can either use fixed stop loss and take profit ratios, or include the ATR indicator and base our stop loss and take profit prices on the volatility of the market. We can also use a trailing stop. Another idea is to open the trade into two different parts and close half of the trade at half the take profit value and leave the other half running or opened, trying to earn the maximum out of the market if the trend is going in our favor, of course. So as you can see, there are many ideas, and there will be also derivatives from these ideas and combinations of these different ideas. We can change the lot sizing, we can change the way we are exiting the market, and the only way to know which option would be the best in terms of profitability is to try all of these ideas and include them in the backtest in our Python code. Whatever numbers we're going to get, the results of the backtest will show which is the safest and the best strategy to pick. And that's what we will be building, and we will start coding in the next video. Now let's start building our trading system and testing it. The first thing we need to do is to download the data, and I'm reusing a function that we have defined previously in this course, which is the get data. It takes a symbol and it's using YFinance download function to download the data. We're downloading the daily time frame. We're downloading almost 1,000 days of data, and this is the Bitcoin versus US dollar. We can run this cell, and I'm going to insert a cell right after it to print the content of the data frame just to make sure that we have the data. And as we can see, we have 1,000 rows, and this is what we have downloaded here. It's 1,000 days, so it makes sense. And we have the open, high, low, closing, and adjusted close price with the volume if you need to use this data. Now, the next step is to add our rejection signal. As we have discussed before, we are looking for support and resistance levels, and we're looking for rejection candles happening very close to these key levels. So the first thing we need to do is to detect these candles, these rejection candles. And to do this, I'm defining a new function called identify rejection. It takes the data frame and it's going to return the data frame after adding one column, one extra column, which is the rejection right here. So that's a new column that's going to contain a categorical variable. If we have a bullish rejection, we are returning 2. If not, if it's a bearish, we're going to return 1. And if we don't have any rejection patterns, we're returning 0. So we don't have any rejection signals at that particular row. So I'm using a lambda function in Python, and we're checking for these conditions. These are the conditions that would define a bullish rejection candle. And the bullish rejection candle has to have the minimum between the open and close price. So it's the lowest part of the body of the candle minus the lowest price. So this is the tail of the candle, the lowest tail of the candle. This part should be greater than 1.5 times the body of the candle. And this makes sense. If you look at rejection candles, like this example here, we have the body, but then we have a long lower tail. And this is what the first condition will look for. So we assume that if the tail is greater than 1.5 times the body of the candle, we have a long tail, a relatively long tail. So of course, you can change 1.5 to 2 or to 3 if you want those extreme long tails candles. But for the moment, we're sticking to 1.5. It should be enough for our example. At the same time, you don't want these to be applied, this condition to be applied for candles with very narrow body, because in this case, this condition is going to be true no matter what if the candle has a very low body. So this is why we're adding this third condition here. So the absolute row open minus row close, so the body of the candle should be above the opening price, whatever the value is, times 0.001. So it's a certain percentage of the current price or the opening price of the candle. So the candle has to have a certain size of the body to be valid for this signal. And we have another one, the upper tail of the candle should be below 0.8 times the body of the candle. Again, if we take the same example of this rejection signal or rejection candle, notice that the lower tail is very long, we have a body, but then the upper tail is showing no sign, it's very short. And this is what we're looking for. This is why we need that the upper tail, we need it to be lower, less than 0.8 times the absolute value of the close minus the open price, so which is the body of the candle. This coefficient, it's a magic number here, 0.8. It can be 0.6 or 0.5. It's just something that you would want to adjust to select those candles or rejection signals. You might want to be very selective. If you want, you can decrease this coefficient and increase this one. Or if you want to loosen up a bit to get more signal, these are good numbers. The second part of the function is the opposite. It's a bearish signal. So we need an upper tail to be greater than 1.5 times the body of the candle, and the lower tail should be a short one. At the same time, we need the same condition on the body of the candle. We need a certain size of the bodies of the candle. And this is it, basically. So we're adding all of these categorical variables, 2, 1, or 0, into a new column called data rejection, and we're returning the new data frame. Now I'm running this one, so the new data frame is equal to identify rejection, and then I'm feeding the data frame in it. Let's run the cell and print the rows where we have a rejection signal different than 0. So we can see that we have this data frame now. We've added this column, rejection, and we have 2, 2, 1, 1, 2, etc. So, for example, candle 20 is a bullish rejection candle. And we're plotting these on this chart here to check that it's working properly, that the function is working properly. So let's check the number 20 here, the index 20 for the candles. This one. So this one is a nice rejection candle. As we can see, our function is working nicely, and everything is looking correct at this point. The other one is this one, so 28. As you can see, these are marked with the purple points below the candles, and if you have a bearish signal, the purple point is going to be placed above the candle. The way I'm visualizing this is using this cell. So I'm adding a point position. I'm defining a new function called point position. It takes x and then the signal, x signal. If the signal is equal to 1, so if the whatever column we need to use as a signal, I'm using rejection here. So if the rejection column is equal to 1, in this case, I'm returning the high plus 1, 10 to minus 4. I'm placing, if you want, I'm placing the point or the purple point above the high of the current candle. And if we have a bullish candle, a bullish rejection candle, I'm putting the point below the low, minus 10 to minus 4. So these are just positions. It's generating positions for the purple points that we're going to use to display those signals on the chart. Then I'm defining a new function called plot with signal that takes a data frame, and it's going to plot the chart, of course, of the candles, the open, high, low, closing prices, and we're adding on top of it the scatter, where we're putting those points or those signal points as markers, giving them a color, so medium purple with a size equal to 8 and the name is equal to signal. Then we can use these two functions. So data position, this is a new column, is equal to data.apply, the point position, using the rows. So we're applying it to each of the rows of the data frame, and we're using the rejection as an input, the rejection column as an input to know if we are going to place the point above or below the candle. At the same time, to plot everything, including the points, we're going to feed within the plot with signal function. We're going to give it a slice of the data frame where we want to plot our signals. And this is what it provides us with. We can see that we have those rejection candles and the purple points are working properly. So this one is a bearish one, this one is a bullish one. And the idea now is to define the support and resistance functions and to test if these rejection candles are happening close to any key levels. To define a support, we're looking at each candle and we'll be looking at the left side of the candle and the right side of the candle as well. And we need that this candle has the lowest point, for example, between its neighbors. So we're considering this point, for example, a support level for the future. Why? Because we have a price that wasn't reached by the neighbors on the left and on the right of the candle. And this is why these functions, support and resistance, they take the data frame, of course, they take the current candle index to test if the current candle is a support level. And we have the number 1 and number 2 variables or arguments here. And these are the number of candles that you want to consider on the left and on the right of the current candle to check if it's the minimum price among these neighbors or the maximum price among these neighbors. So this is how we're doing this using Python. It's very short and concise way of writing things. We're just checking the low prices between the left slice L minus N1 up to L, the current candle, and we're selecting the minimum price between these candles, which are the left neighbors of the current candle of index L. We're testing if the minimum price is lower than the current candle's low. If it's the case, or it's the same for the right candles, so if we found any minimum here on the right of these candles that is lower than this candle, then this candle is not a signal. It's not a support signal. This is why we return 0. In any other case, it means that the current candle is showing the minimum value or the minimum value of the price among its neighbors on the left and on the right. And in which case we can return 1 because this is a support level. In the opposite case, for the resistance, we're just checking from the opposite direction. So we need that the maximum of the current candle we need it to be greater than all the maximum of the left neighbors and the right neighbors. So let's check it out on this one, how to do this. So we're checking the high for all the neighbors on the left and the maximum of these highs if it's higher or greater than the high of the current candle. Or on the right side, L plus 1 up to L plus N2 plus 1, and the maximum is above the high of the current candle. If any of these conditions is verified, this is why we have the OR here. It means that the current candle doesn't hold the maximum price, the maximum value of the price among these neighbors on the left and on the right. And this is why it's not a resistance level. It's not representing a resistance level. This is why we return 0. In any other case, then it's showing resistance and we return 1. Okay, so now we have our support and resistance detection functions, and we also have our rejection patterns functions. And we want to test if these rejection patterns are happening close enough to those key levels, meaning the support and resistance levels, to generate our signals or entry signals to the market. To do this, we are defining these two functions, close resistance and close support. Let's break down these parameters and see how these functions work. The close resistance function takes 4 parameters: L, levels, limit, and the data frame. L represents the index of the data point being examined, which is the current candle. The levels parameter is a list of resistance levels, and the limit is a threshold or a limit used for comparisons, meaning that if the candle is close within a distance that is equal to limit here to a key level, then it's considered close enough to any of these levels. So every time we're going to test if the candle L has any part of its body close enough to the closest level among this list within a certain threshold, which is the limit. And then the data frame is the data frame where we have all our data or the candles that we're going to pass to the function. If the length of levels is equal to 0, so if we don't have any levels, in this case we return 0 because there's nothing to test. Next, the function evaluates 4 conditions based on the high, open, close, and low prices at the given index L for the current candle. The first condition, C1, checks if the absolute difference between the high price and the nearest resistance level is within the specified limit lim from the arguments. And this is done here in this first condition. So we're looking for the closest resistance level to the current high of the candle, and we're checking if the difference or the distance between the high of the level and the closest level is below or equal to the limit parameter. Condition 2 is something very similar. However, it's going to check, instead of the high, it's going to check for the maximum between the open and the closing price of the candle. So we're looking at the body of the candle and not at the tails or the wick of the candle. And we're also measuring if the closest level or the distance to the closest level from the maximum between open and close is below the limit threshold. So these 2 conditions are to check basically if the candle is close enough to the closest level of resistance. Condition 3 verifies if the minimum of open and close prices is less than the nearest resistance level for the high price. In other words, we're checking if part of the candle is still below the resistance level. We don't need the candle to be a breakout candle. We need it to be still confined under the resistance level. Condition 3 is checking if the low price is below the nearest resistance level. So it's basically the same as the previous one, only this time we're taking the lowest part or the lowest price of the current candle. I think these 2 conditions are not mandatory. We can take either one of these. So if the body or the minimum part of the body of the candle is below the level, this would mean that definitely the lowest price of the current candle is below the level. If condition 3 is true, then for sure condition 4 will be true. So now we can combine our conditions. If condition 1 or condition 2, again, if any part of the candle, the highest price or the open or closing price is close enough to the resistance level, then we consider that the candle is close to this level, to this key level. And at the same time, if a part of it is still below the level, then it's confined under the level, which is good. In this case, we return the levels or the level that is concerned. In any other case, we return 0, so we don't have a signal at this particular candle. So this function is not only returning if we have a signal or not, or if the candle is close to the level or not, it's also providing which level is it close enough to. The close support function, much like its resistance counterpart, takes 4 parameters: L, levels, limit, and data frame. And L represents the index of the data point being examined, the current candle. Levels is a list of support levels this time. The limit is the threshold used for comparisons, and the data frame is the last argument here. So the logic behind this function is very much like the other one, like the close resistance, only in a symmetrical approach. The initial check ensures that there are support levels to analyze. If the levels list is empty, the function returns 0, indicating a lack of significant support. The function then assesses 4 conditions from 1 to 4 based on low, open, close, and high prices at the given index L for the current candle. So the condition 1 will check if the absolute difference between the low price and the nearest support level is within the specified limit. So the body of the candle is close enough within the threshold to any support level. Condition 2 is similar to condition 1, but compares the absolute difference between the minimum of open and close prices and the nearest support level. And the third condition verifies if the maximum of open and close prices is greater than the nearest support level for the lowest price. It's just checking basically if the candle has prices above the support level. Condition 4 ensures that the high price is above the nearest support level for the low price. The reason we have these somehow redundant conditions in a way is that you can combine them differently to get to different ways of generating your signal. So for example, if you want to just confine all the candle below the resistance or above the support, including the high and low prices, then we can impose these conditions here. If we want just to focus on the body, disregarding the wicks or the tails of the candle, we can also disregard whatever is related to the wick or the tail of the candle, which is condition number 4, and so on. So as these two functions are ready to use now, we can use them in our code. But just to be aware of things and these conditions, you can modify them to change the type of pattern you would like to detect. Now we still have to introduce these two functions, is below resistance and is above support. So the first one, is below resistance, is a handy tool to understand if the current high price is below a specified resistance level over a given period of historical data. So it takes these parameters, the L, which represents the current index of the current data point or the current candle. Level back candles defines the number of previous candles to consider for the analysis, which is our time window basically. The level is the resistance level to check against if the candles are above or below this level, and a data frame, which is our fourth argument. The logic is the following. The function checks whether the maximum high price in the preceding level back candles, so the time window basically defined by the level back candles parameter. So it will be checking if the maximum high price within this window is below the specified resistance level. In other words, we're checking if all the previous candles within this window are below the resistance level. And for this, we are comparing the highest points or the highest prices of these candles. We're taking the maximum of these candles, and if the maximum of these candles in this time window is below the level, then we're returning a value, we're returning true. In any other case, we return 0. The second function, is above support, is checking if within the time window or the candles window from L minus level back candles up to L minus 1, so the previous candles which are preceding the candle of index L, the current candle, all of them are above the level that we are studying. So if this level is lower than all of these, we are talking about a real support level, in which case we return true. So far we're talking about 3 conditions. We need to have a support resistance level. We need to have a rejection candle happening close enough to one of these key levels. And at the same time, we need that the previous candles preceding the rejection candle, they should be either above or below the resistance and support level. So if it's a resistance level, we need all the candles to be below this level. And if we are talking about a support level, we need the candles to be above the support level. Now we can combine these conditions to generate our entry signal. We're defining a new function called check candle signal. It takes L, the index of the current candle, N1 and N2. We've seen those. These are the number of left neighbors or preceding neighbors and following neighbors or future neighbors of the current candle to detect the support and resistance levels. And we need to provide also the level back candles, which is a time window, a large time window before the current candle in which we are going to detect the support and the resistance. So all of this testing for using N1 and N2 is done within a time window. If I'm looking at a current candle, I just need to look to, let's say, 40 candles before that to extract the support and resistance levels if there are any that are occurring in there. Then we need the window back candles, and this is usually a smaller window of candles where we're going to test if we have is above support or is below resistance, two functions that we've previously mentioned. And then we have the data frame. Let's take a look inside the function and see how it works. We have two lists, support and resistance, that are empty for the moment. And for each of the candles within the large level back candles, so we're looking back from the current candle L minus level back candles up to L minus N2 plus 1. So why this small gap? It's to avoid look ahead bias. And if we have a support, we're going to append its value, the level of the support, to the support list. Same thing if we have a resistance level that is detected, we're going to append its value to the resistance level. Then we sort those lists of support and resistance because we need to merge values that are very close to each other. So in other words, if we have two levels that are very close to each other within a certain percentage, within, let's say, 1 per 1000, we're going to merge these by erasing just one. So this is why we're using the pop function here and keeping the smaller one. Same thing for the resistance level. For the resistance, we're keeping the highest one. This is why we're going backwards using reverse equal true. We're keeping the highest resistance in between two levels. While for the support, we're keeping the lowest support between two close levels. So now the levels are merged for support and resistance lists. We can join these two lists into one list that has both the resistance and support levels. We don't have to do this step. You can keep them separated and do your study using two separate lists. But I considered that sometimes the same support or resistance level, they will play both roles. So if a support level is broken, it can play a resistance level in some other circumstances and vice versa. This is why I joined the levels into one list. Then I'm sorting the list and I'm doing the merging again, because this time also we might have different levels that are very close to each other. And we don't want to have those redundant levels. It will mess up our algorithm. So once this is done, we can call these two functions, close to resistance and close to support, which will test if the current candle is close enough within a certain percentage of the closing price to a resistance level or to a support level, providing the list of these support and resistance. So we're providing the list of all those key levels together. And now we reach the end of this function where we can generate our signals. So if we have a bearish rejection candle combined with a candle that is close enough to a resistance level, and also all the previous candles are below the resistance level, it's most probably this scenario where we have a climbing candles, climbing prices, then getting closer to a resistance level, and then a bearish rejection signal, a bearish rejection candle. Most probably on the daily time frame, the price will be bouncing down or reverting down, and this is where we can take advantage of this. So we return 1 as a signal because this is our bearish entry signal. In the opposite direction, if we have a bullish rejection candle and close to support, and all the previous candles are above support level, we return 2 for a bullish signal. In any other direction or any other cases, we return 0 because we don't have any entry signals. Now we can use this function to generate these signals and add them as a new column into our data frame. So for this, we have to specify the N1 and N2 parameters. I'm taking 8 candles before and after the current candle to detect if it's a support or a resistance level in case. And then the level back candles is equal to 60. So over 60 days or 60 candles before the current candle, we're taking this window to check if we have support and resistance levels. And then the window back candles is equal to N2, which is enough for now. It should work. We're defining an empty signal list for now equal to 0 everywhere. And for each candle in the range going from level back candles plus N1, this is a small gap at the beginning because this is what we need to compute We need this level back candles at least to compute resistance and support levels to be able to do our study for the signals. And up to the end of the data frame minus the N2 window, the signal row value is equal to the result of the check candle signal function, which is provided here in the previous cell. So once this is done, we store all the values in our data frame, and we can print the rows where we have a signal that's different than 0. So notice that we have candle 220, for example. We have a bearish signal. This one is also a bearish signal, and this one is a bullish signal, and so on. The easiest way to have a quick look at these signals and their validity is to plot these. We're going to use those two functions that we've already predefined in this Jupyter notebook. So I'm using the point position function, and I'm providing the signal row, which is this signal that I want to plot on the bar charts. And then I'm plotting the bar charts or a slice of my data frame, provided the point position or the signal's position. Let's check. So here we have, this is a bullish signal. This is candle 626. So it's this one. Okay, I took a random one. It's a bullish signal. And indeed, we have an excellent signal because afterwards, for many days, for 2 or 3 weeks, the price was climbing. Let's check for another one. For example, 220. So we need to slice it. And I took from 150 up to 350, and this is our bearish signal. Let's zoom in just to see a bit clearer. So it is a bearish rejection candle. It's happening almost close to a support or a resistance level. And we didn't have a straight down movement. The movement actually happened after a while, after 5 days. So this would have been a stopped trade in my opinion. Although the price went down later on, but I don't think it's related to this particular signal. The other one is 379, so it's this one. And we can see that it's also a great signal actually. So we have this rejection candle happening at resistance level, and the price immediately reverted back down, going very well down. Now, the problem is to guess how you can manage your trade after it's open to squeeze the most of the profits out of the market. But this comes with experience, and you need to have a trade strategy. You need to have a very smart strategy to manage the trades after they are opened. But anyway, the signal is a great one. We can also verify another one like 422. Let's check. So I'm plotting from 350 until, let's say, 550. So 422 should be somewhere. This one is 379, so it's a good one. 422 is a false signal. Look at this one. So it's happening at a resistance level. It's kind of a rejection candle that we can filter actually because the body is way too small. But for now, the way we've built this algorithm, this one is kind of a false signal. Let's check the other one. So 624, I'm not sure if we already mentioned this one. So from 500 and something up to 750. 624, yes, we've seen it. So it's a good signal. Check the 702, 702, 600 to 850. So this one is a great bullish signal, as you can see. So we had support, a strong support apparently, and a very small rejection candle, but nevertheless the price spiked up. It took a strong uptrend afterwards. 848, we can check this one. This one is also a good signal. We have a rejection candle, and after it we have a price climb, as you can see. So let me run it again so we can plot it well. It's this one. So we have a climb in the price. It's not seen here, the scale of the climb, because of the scale of the y-axis. But when we plot it this way, we can see it clearly that we have a spike after the rejection candle. This is a very strong rejection candle. Notice that the tail is almost twice or greater than twice than the body of the candle. And this is why we've seen this spike in the movement straight afterwards. We still have one signal in our data frame to test. It's the 890, and I think it's this one. Yes, it's a good signal. It's kind of tricky because there's a strong resistance level. Apparently, the price is bumping into this level so many times, so many days. It's exceeding the price slightly on this one, but again, the price went down afterwards. There's a downtrend afterwards. So if you'd have to open this trade on the daily time frame, you have to give a trade 5 to 6 days to show the potential of the trend. It's not going to be immediate like this one here. If you are lucky, this immediate movement is a great opportunity to capture the market within 2 or 3 days. But on the daily time frame, usually you have to wait a bit. Otherwise, you wait for the trend to start. So we don't really trade on the signal. We wait a couple of days. If it's confirmed that it's going down, we can join the trend, and although with limited profits, but it's better to be sure than to take a risk if you don't like to do so. It depends on your trading style. Okay, now we have our signals, everything is ready. We can try and backtest this strategy. And to do the backtesting, first of all, I'm printing the data frame, and we can check the signal column is here just to make sure everything is working fine. I'm setting the index to date because we will need the date column as an index for the testing to get the quality ratios with the backtesting library. And to do the trade management, the exit strategy, and so on, I'm defining two new columns in the data frame, the ATR with length equal 14. I'm not modifying much here. And the RSI with length equal to 5. These will help me enter the stop loss and take profit values and exit the market at the correct moment. And to use backtesting with the backtesting library, we're going to define a function called signal, which returns the column signal from the data frame. That's our entry signal. So now we can import from backtesting the strategy class and the backtest class, and we're going to create our class, myCandle strat, for example. It inherits from the strategy class, and we're defining signal1 is equal to signal, and the ratio variable is equal to 2, so the take profit stop loss ratio is equal to 2, and the risk percentage is 0.1. So this first strategy that we are testing here, the entry signal is taken from what we have explained already in this notebook, but the exit signal, the take profit and stop loss values are fixed during the whole backtest, and they are dependent on the price itself. So it's 0.1% of the price, of the closing price. Let's take a look at it. If the signal is equal to 2, so it's a bullish signal, we're going to execute a buying position to open a buying trade with a stop loss and take profit values. But the stop loss is equal to the closing price, the current closing price, because it's a bullish market. So we're buying, it's a bullish trade. So the stop loss value is equal to the closing price minus the closing price times a certain percentage. So we are removing a small percentage of the current closing price, and this is how we're putting our stop loss. The take profit is equal to the current closing price plus the self data closing price, etc. So whatever we had, this distance of the stop loss times the ratio, which is the risk reward ratio. The distance to the take profit is twice as large as the distance to the stop loss. And the same thing in the opposite direction is for the signal equal 1. So it's a bearish signal, we are selling, and this is why the stop loss is above the current closing price. So this is why it's equal to the current closing price plus the closing price times a certain percentage, so the risk percentage. And the take profit is below, so it's the closing price of the current candle minus the distance of the stop loss times the ratio, so twice times 2. And that's it, basically. This is all we have to do to start our backtesting. This is the entry signal. We have a fixed take profit and stop loss distances for the whole set of trades that we're going to open. And these are dependent on the price, so it's a certain percentage of the price and the risk reward ratio. Let's run this one. We're running with 100K of cash. I'm not computing the commissions for now as a first trial. And these are our results. So the duration is the whole data frame, 1000 days. The equity final is 160K instead of 100K, so that's profitable. And buy and hold returns are 4%, so we have 60% in return. This is around 3 years of data. That's giving us around 18% of returns per year. Remember, this is not an optimized strategy. I didn't optimize anything. I just put some values, some random percentages, some just around 2 of risk reward ratio, and it's working this way. The Sharpe ratio is 0.7. I prefer the Sortino ratio, which is 1.39 in this case, and it's a very good ratio. The Kalmar ratio is 0.75. Maximum drawdown is minus 24%. That's quite large. And the average drawdown is minus 5%. We have 6 trades. And the win rate is 66%. That's not bad. The best trade brought 20%, and the worst trade put us down minus 10%. Average trade is in positive, so it's plus 9%, taking into account all the trades, winning and losing trades. We could plot it, bt.plot. I'm not sure if it's worth showing the equity and everything that comes in between. So if we take a look at these, we can see a losing trade here, although the price went down, but we didn't close it at we didn't close the trade at the correct moment. These were closed correctly. This one was also an escape because we could have been stopped right here, but we had a distance, we had a margin distance, and so on. So we can see the equity is going up and sometimes down here, but overall we had the edge over the market. And we can start increasing the commission to see how much commission this strategy would withstand before starting to be non-profitable. So remember that we're not using any leverage here. If we would add the leverage, we would increase the risk, but also the rewards. Let's check it out. So we have 2 per 1000 in this case. So we're dropping our returns annually to 17%. And if you want to go up to 2%, which is a huge commission actually, let's see if we can still make it. And we're still actually 13%, around 13-14% per year. This is an excellent strategy, but the only thing is that we didn't test it on different assets, and we can't make sure that it's a robust strategy. So it has to be tested on more than one currency and one trading market. You need to test it on, I would say, 10 sets of data, 10 different times, and try to make more frequent trades, because this is only 6 trades here that we've got. In any case, this strategy looks promising, so let's go on and try using the RSI for exit signals. And I'm showing you these methods here as an example for exit signals. This is not an exhaustive list, but just showing you, if you have an idea how to exit the market and how to manage the trades, how you can incorporate this into your backtesting. So again, I'm using the class myCandles strategy. We're defining this risk percentage and then the ratio. Now at the beginning of the class right here, so in my trading function, if the length of self.trades is positive, so if I have any opened trades on the market, I'm going to check if the last trade is long. Is it a long position? And at the same time, if the RSI for the current candle is above 80, in this case, I'm closing this open trade. Why? Because if the RSI goes above 80, we consider that the market is overbought, and our uptrend, at least for the short term, is going to be halted or stopped. So this is why we exit our long positions. On the contrary, the opposite side, if we have a short position and the RSI is below 20, in this case, we close this shorted position. So this is how we can close these positions, not only relying on the stop losses, but also relying on the RSI. So whichever comes first, either the stop loss or the RSI is going to close our open trades. And in here, I added a condition this time. So if the signal is equal to 2 to open those trades, we need also at the same time to have 0 open trades. This way, the algorithm would allow only 1 open trade at a time on the market. So the stop loss is again equal to the current closing price minus the closing price times the risk percentage, and the take profit is equal to the closing price plus the stop loss distance times the ratio percentage or the risk reward ratio. And then we open this position. This is a long position. This is a short position. I'm testing this again with 100K of cash. We're running this and we obtain 79% in return. So this is better. We have a win rate of 100%. So all the open trades, we opened 7 trades and all of them were winning trades. The best trade is 17%. The worst trade is around 2.9%, so it's around 3%. The Sharpe ratio is 1.2. This is a good one. We're starting to get above 1. And the Sortino ratio is 3.3, almost 3.3. I think this one works well on daily time frame. Remember that we didn't use any margin, so we could increase those results. So if I add the margin equal, for example, I don't know, 1 to 5, we could run this test again, and we have 1,500% in return. So an annual return of 175%. This is a huge. I don't know if it's a good thing to take that much risk, because anyway, we can notice that the Sharpe ratio is now less, so 0.5, because the risk is greater, and we have the standard deviation or the fluctuation of our return of our equity is more important, and this is why the Sharpe ratio is decreasing. And this would indicate that that's true while we have higher returns, but the risk is greater. This is why the Sharpe ratio is lower. Sortino ratio is still 4.337. The Kalmar ratio is 4.1. And we have a drawdown of minus 40%, 42%. That's huge. We're still around 100% of win rate. We have 7 trades and so on. I could plot this, show you the shape of the equity, and we can see that it's constantly increasing. We don't have a lot of drawdowns because we're exiting the market actually now in a better way. And notice how we didn't change anything on the entry signal. We just changed the exit signal. And this is what improved our results to 100% win rate compared to the previous way where we used fixed take profit and stop loss ratios. Now I'm going to remove the margin, and to compare with the previous case, we will start adding some commissions. Let's add the maximum commission, which is 2% now. And our returns are down to 19% per year. That's still a good thing. It's still a good strategy for now. But yeah, we can add 5% commissions. Not sure it's going to work, but this is huge. 5% is a lot of commissions. And we are still making returns of 35% and an annual return of 11%. For a fully automated strategy, this is a good result. I don't know if you've had any previous experience trying to automate strategies, but 11% on a fully automated system as an annual return is a good start. Another way to define the stop loss and take profit values is to use the ATR because it takes into account the volatility of the market. So if you have a highly volatile market, you would increase the stop loss distance to take the ATR into account. And in the opposite case, if you have a very squeezed market with a low volatility, there's no need to have a wide stop loss distance. In this case, we're going to take a distance that's very close to the entry position. And how to do this? So instead of using random numbers or magic numbers, we're going to define the stop loss based on the ATR value. So it's equal to the closing price minus the ATR. So we're not using the ATR as is, we're using the ATR, a fraction of the ATR, or multiplied by a factor. There are different ways of doing this. We could multiply this by the coefficient, for example. So instead of 0.5, I'm taking twice the ATR, for example. And instead of dividing here, I will be multiplying as well. So we need to multiply it right here and right here. And then we run this and we have the least, we have 19% as a return and an annual return of 6%. It doesn't look very promising. Win rate of 57%. I don't know. It's probably the fact that the stop loss is very squeezed. It's very close to the entry points, and this is why we are being stopped, and we're not exiting at the good moment as well. So yeah, it's working for some trades. It's not working for some others. It's good to tune it, so we can change this ratio here a bit. The best way is to optimize it using the optimize function. So now, okay, now we have even less returns. Let's try to increase it. Try, for example, 5 times the ATR. And no, we're not getting good results using this one. Okay, maybe if we change the ratio to 2 and the ATR to, I would say 2 as well. Could we get any closer to the previous results? Now we have 12%. It's not going to, it doesn't look very promising from my side. So we have 31% here, but I'm not sure it's going to beat the other ways of trade management. If you want to optimize it, instead of the bt.run, we can use the bt.optimize that we have seen in the previous sessions in this course. You could proceed with a grid search over the ATR_F and the ratio_F variables. Okay, so you get the point. We can use the ATR. Now let's move on to the next one. Now we can start using the trailing stop. So the trailing stop is going to chase the price of the asset as long as it's moving in our favor. So if we have a winning trade and the price is going to our favor, we're going to chase it with the trail stop in order to squeeze out the maximum profits out of the market. So we're going to follow the market as long as it's going in our direction. This is good. It works in highly trending and fast-moving markets. In some cases, it might not be the best choice. But the way to code this, again, we're defining our class, we're bringing our signal, and then we need a distance within which to follow the price. So this is the stop loss trail, and it's equal to the closing price, the current closing price, times 0.02. So it's 2% distance from the current price. In other words, we're putting the initial value of the stop loss away by 2% from the closing price. That's our stop loss distance. And as long as the price is going to move in our favor, we're following up with the stop loss considering this distance. So for trade in self.trades, for all the open trades, if the trade is long, the trade stop loss is going to change for every candle. So for every new candle, we're moving the stop loss to be equal to the maximum between either the current trade stop loss or NumPy Infinity in case this one is not available. We don't have a stop loss yet, and the closing price minus the stop loss distance. So it might take you a while to digest this expression. That's okay. You can pause the video, take your time, go through it step by step. But most importantly, this is how we are coding the trailing stop. So it's going to chase the price and we're going to change its value for every new candle. We're testing if it's a long position, and otherwise for a short position, we're moving it in a different direction. And we have 18% in return. I would expect the best trade to be quite good. So we have 25% for the best trade, because that should be a long distance or a long movement where the trail stop chased the price for a long movement trend. And this is where we've made a lot of our returns on this one. But surprisingly, it's not working extremely well for the other cases. Maybe it's the initial price. So the advantage here on this one is that we can optimize it, and we're only optimizing one parameter. So we don't have two parameters. It's always simpler to optimize with one parameter. And you can use, again, the bt.optimize, so the backtest.optimize function instead of the run function, to optimize and get the best possible result out of this approach. Okay, now let's talk a bit about the lot sizing and trade management. So far, we haven't specified any lot size, if you notice. So when we are opening a sell position or a buying position, we never put the size of the lot. Now we're starting to put the lot size, and in backtesting.py, you put a number that's below 1, so let's say 0.5. That means that you want to trade with 50% of your equity. So the lot size is whatever 50% of the money you have is going to buy you. If you put 0.99, for example, it means that you are buying with all the money that you have at once. So each trade will be the maximum lot size. And that's okay. That's not as risky as you think, because we're not using a margin here. So we're just flipping our money from one currency to another. And if we use a lot size that's above 1, it actually means the absolute lot size that we'd like to buy. So 1 means 1 Bitcoin in this case, because we're working on the Bitcoin US dollar data. If I put 2, it means we need to buy 2 Bitcoins per trade, and so on. So it's not a percentage, it's more a unit that you are buying. So now let's define the ratio and the risk percentage that we have previously used in previous strategy, in previous tests. And if the signal is equal to 2 and we don't have any open trades, now I'm going to define one stop loss distance, okay, that we have seen before, but also we're defining two take profit values. One that is equal to whatever we have used before times 0.8. And the second one is equal to whatever we have used before times 1.2. It means that we have two take profit levels, one that is closer to the entry point than the other one. So one is close, one is far. Why? Because we want to secure, let's say, a part of the trade, put this already in our pocket, and let the rest run on the market, just in case we could eventually bring more profit. Ideally, we would also move the stop loss in this case. So when this happens, when we have one closed position or half of the trade closed, we would also move the remaining stop loss value to the entry point to break even, so we can't lose anymore. We don't have any losing trade anymore. So now to do this, to apply this, we're going to open two positions. When we have the signal, notice that I'm using this line twice. So I'm buying the first time with the stop loss SL1 and the take profit TP1. The size is equal to the lot size, which is 1 Bitcoin. And the second one is the same stop loss, but the take profit 2. So we have two take profits. And this is why in this case, for this type of backtesting, we used the lot size, because we need to fix it so it would be equal. So we would have two equal trades that are opened with two different take profits. So now I'm going to remove the commission, first of all, to be able to compare it with the previous strategies. So we have 35% as is in return, around 11% per year. So that's not very bad. We can add some commission, so 0.05, 5% that we've added before, and we are still 5%, around 5% in returns per year, because in total over 3 years it's 15%. And the win rate is 92%. That's not very bad. The Sharpe ratio is 0.4. That's not very good. It's not very encouraging. And the maximum drawdown is minus 10%. That's safe enough, but I think the Sharpe ratio is not high enough because we didn't have enough profit, so it's just 5% per year. But among the previous approaches that we have already tested, I think this one is the safest with a maximum drawdown of minus 10%. And the first one we have tried with fixed take profit and fixed stop loss has a maximum drawdown of minus 26%. This is also huge. So anyway, you get the point. You don't need to have a high risk, so not a maximum drawdown, not going below minus 10% as the lowest, because then it would be too risky as a strategy. And just before I end this video and this session on this strategy, we could apply the bt.optimize, so the backtesting.optimize function to optimize our strategies. We're providing some parameter grid. So if it's a grid search, we're providing the list of values for example, for the ratio and for the risk percentage parameters that we are using in the class right here. So these two. So you have to move them here to the beginning of the class and use them throughout the class. And we can optimize these values using a grid search, and this is what we will be getting for this one. So it's 37.8%, and these are obtained for a ratio of 1.5 and the risk percentage of 0.1. Of course, this has to be worked out again with some more details on what kind of range we are using here, what are the values, what's the list of values we are providing for the optimization method. But this is how you can use it to optimize your strategy and try with different values for these two variables. And now we reach the last Jupyter Notebook and the last example for this course. In this Jupyter Notebook, I'm going to show you how to run your strategy live on the market. And for the sake of this example, we're going to use Owanda's API. So one thing we should know, if you want to run live on the market, even using a paper account or a demo account, you need to go through the broker. And for this, the broker has to provide a Python API. So if your broker doesn't provide any Python API, there is no way you can connect your Python notebook to your broker's account and then execute trades, open trades, and so on. So the first thing you need to check is the broker you're dealing with supports Python API. And the second step is to go through their documentation and read what kind of functions they are providing, what kind of classes they are providing. For example, in the case of Owanda, they are providing this API here, Owanda Python v2.0, so v20. And they have also the Owanda candles. So this is to grab the candles. And it provides these classes, they provide different functions that we're going to import and we're going to use to open our trades on the market. So if the broker doesn't provide such an API, there is no way you can go through them. You have to open an account with a broker that does provide the Python API. I know that interactive brokers, Alpaca, Owanda, the known names in the Forex and the stock markets exchange, they do provide now the Python APIs, among other tools to apply your trading. So back to our Jupyter Notebook, the first thing we're going to do is to download data as usual. So I'm not going through the details of this function. I'm using yFinance. So why are we using yFinance here? I'm just querying some data, like 300 days worth of data on a daily time frame, just for the sake of testing few functions before we use them on the live trading account. So I'm just downloading the data of the Bitcoin US dollar, putting these in the data frame called data. Then I'm plotting these just to make sure that the data looks correct, because sometimes with yFinance we have some weird values and the columns are messed up. In this case, we need to verify that the candles, they look normal, like any normal chart you would look at. And in this cell, I'm just copying and pasting. I just brought all the functions of the signals that we have previously discussed in the previous videos. So we have the identify rejection. This is a function that's going to detect the rejection candles, and it's going to add these as a new column in our data frame. We have the point positions. These are mainly for plotting the signals. We have the plot with signal function as well that we have used in previous video. I'll not go through all the details now to save you some time because these were explained in the previous videos. We also have the support and resistance functions. So these are used to detect the support and resistance levels. And we have two other functions called close to resistance and close support. This is where we're going to test. We're going to use these functions to test if we are close enough or a candle is close enough within a certain threshold to a resistance level or to a support level. And we have the last two functions here are is below resistance and is above support. These are used to check if the previous candles are all below or above resistance and support levels. So we have seen all of these functions in previous videos. If you have missed some of these, you might want to go back to the previous sections and watch the details and the detailed explanations of these. Next, we're going to use the check candle signal. Also, this is a function that we have previously explained and defined in previous videos. So it takes the current candle index, number of neighbors on the left and on the right to test if it's a support or resistance level or none of these. And the level back candles. So this is the window of back candles that we want to consider to compute the number of key levels and to detect these key levels. I mean the support and resistance levels. And the window back candles is a slice of back candles that we're going to apply to avoid look ahead bias. It usually should be greater than N1 and N2, mainly N2 actually, because this is on the right of the candle. And the DF is the data frame with all of our candles that contains all the data and the historical data that we're going to be testing. So now we're applying within the check candle signal. Now I'm applying the identify rejection. So I'm adding one more column to the data frame where we have rejection signals. And we are using the function just as we have used it before in the previous videos. And at this point, we are ready to test our signal function. So I'm defining N1 is equal to 5, N2 is equal to 5 as well. And the level back candles, I'm taking 100 days just to detect support and resistance levels. And the window back candles is equal to 5. So just a reminder, it should be either equal to or greater than N2. And we're defining a new signal list that we're going to fill with the signals, considering the data frame that we've just downloaded. And this is just to test if our functions are working properly. So the whole thing so far in this Jupyter notebook, we're downloading from yFinance a data frame. We're plotting the candles to verify that things are correct. Then we're defining these functions, detect the signals and generate the entry signals using also this function, check candle signal, and so on. And this is where we're running this function that would call all the other functions and generate the signal. This is all to make sure that we are getting signals, so the functions are working correctly. Because if I run it on live market, on live data, and it's not working properly, I wouldn't know. I would have to wait like a few weeks before I notice that we're not getting any signals and we're not getting any trades opened on the market. That would be too long to test. There's an easier and faster way to do the test. It's to run it on historical data now. We check that it's working and then we apply it to the live data. So running it on the 300 candles sample that we've just downloaded, we got 297 candles where we had no signal, 2 candles with a bullish signal, and 1 candle with a bearish signal. Let's check it out. We're using these functions to plot the signals. I'm going to run this again. And we can see this is a bullish signal. It's a very nice one. So we have an uptrend afterwards. So it's changing. When I'm zooming in, it's changing the scale of the y-axis, and it's not showing this steep uptrend of the price. But when we look at it from this perspective, it looks impressive. Remember that this is the daily time frame. So these are 3 or 4 days with a very good upward momentum. So this signal is good. This one is a bearish signal. It's more or less good. Tricky somehow because we would have been stopped by this one. unless if we have a different stop loss and take profit management. This one is kind of a squeezed signal, so we did have an uptrend for a couple of days, but then the trend went down. So it's probably safer to close after 2 or 3 days maximum when we have the trades opened with this particular strategy that we have described in this course. So anyway, we just verified that things are working properly. The signals are at the correct place. They are not misplaced, or we're not having any weird signals either. So now we can move on to deploy this or to use this on live market data. And to do this, you need to have the Oanda Pi V20 package and the Oanda candles. If you don't know how to do this, we can open a terminal and we need to install it. So we can do pip install Oanda Pi V20. So it should find the package in the repo. And since I already have installed this, so the requirement is already satisfied, I do have Oanda Pi V20. And it's actually V2.0, but we're writing it V20. And we also need the Oanda candles, this one. So we need to pip install also Oanda candles _ candles. I also have the requirement already satisfied because I just downloaded these. So now we can import whatever we need. We need a scheduler to schedule the jobs at specific times of the day. We need the Oanda Pi V20, the API. We need the orders. We need the market order request. We need the pair, gran, and candle client from Oanda candles. And we need take profit details and stop loss details. One thing we should know is that we need to have an Oanda account. It doesn't have to be a real money account. It can be a paper account, a demo, or a practice account. You just have to open an account, and this would allow you to generate an access token, and it would provide you also with the account ID or the account number. These are two variables that you're going to need. So I usually put these in a config file, like a config.python file on a side, so I don't include them in my code. But in this case, I don't have the config file here because otherwise it would show some of my access token and account ID as a preview in VS Code. Anyway, you know what you need to do. So you need to open the account. You need to have this access account ID and the access token, two things that you can generate and access on the Oanda platform whenever you have an account opened. And if you don't want to put these into a config file, you can simply define these as variables here. So you can put get access _ token, for example. You can define it as a global variable. You can put it here and whatever the token is. And we can also put account ID, for example, right here is equal to whatever the account ID is. This would avoid you defining a config file and importing from a config file if you don't like it. So now we can define the get _ candles and the number of candles we want to get right now. So this is live candles now. So if I call this function, it's going to download candles for me from the Oanda platform. So client is equal to the candle client. Access token is provided. Real is equal to false because it's not a real account. It's a demo account or a practice account. And we're using the collector or the client.getCollector. The pair, I'm not using the Euro US dollar now. I'm using Bitcoin. And here is the time frame that you want to download. So what kind of candles you want to download. This is like the 15 minutes time frame. Can be the daily time frame. I guess it's day 1, so 1 day. And then we can store the candles or save them in a variable called candles. So candles is equal to collector, whatever I have defined here, dot grab a certain number of candles. So 10 candles, 100 candles, and so on. And this is going to grab or download the data for the last or the most recent candles you're going to ask for. So if we asked for 10 candles, it's going to be the last or the most recent 10 candles. In which case here, in this case, since it's the daily time frame, it's going to be the last 10 days candles. So, and then we return candles from this function. That's all. So this function is just downloading the candles, accessing your account, accessing Oanda, and the API and getting you some candles. Now we can call the function get candles. I'm downloading, for example, 300 candles here, and we're saving these into the variable called candles. If you want to make sure that you have enough candles, that things worked properly, you can either print these, or for candle and candles, just print candles. But you get the point. Just verify that you got some candles from the API, that things are connected properly and you're able to get some data from the market. And now we're going to define a new function called the trading job. So trading job, it doesn't take any parameters, any arguments. It's going to use candles. So we're going to use candles here equal to get candles 300. We're streaming 300 candles. Then a data frame stream, that's my new data frame, is equal to columns, open, close, high, low prices. These are just the names of the columns. And now we're going to populate this data frame. And we're going to populate it with candles. The only way I found that works is this one, because we have to cast the opening price of the candles, closing price, high and low price. We're using the bid price here. We're going to cast these into strings, because first they are kind of an objects for Oanda, like specific a type of data. I need to cast these into string and then cast these into a float. So the values now are of type float in this new df stream data frame. And we're just making these columns and populating these, the rows and the columns of this data frame. Then we need to cast these again, the whole column, cast it as type float. And now we can generate our signal using the function check candle signal. I'm providing the first argument is the candle. And for this, providing the index of the last candle. So it's going to be the length of the data frame stream -1. That's the index of the last candle of this one, of this data frame. Then N1 is equal to 6, N2 is equal to 6. We know what these are now. The level back candles equal to 200, and the window back candles equal to 7. And the data frame we're going to use is the data frame stream, so whatever we have downloaded live from the market. And now we need to provide some functions to execute the orders and open the positions on the market. So the client is equal to API function to the access token. The stop loss take profit ratio is going to be equal to 2, so that's something that you want to fine tune. That's related to the strategy you're trying to code and to implement. Then this line is not needed now, so we're not using it. The stop loss buy, for buying positions or for long positions, we need to define a stop loss which is equal to the low of the current candle. If we have a rejection candle like this one and we go for a long position, we're going to put the stop loss at the lowest point of this candle. We have a short position, so we're going to go for a selling position here. We're going to put the stop loss above the highest point of the current candle, because these rejection candles usually have long tails and represent the price where we have a strong resistance or strong support. So it's kind of safe to use these, especially at the daily time frame. So we're going to use these as a stop loss reference for our trading. Then the stop loss for the selling position is the high of the current candle. The take profit, however, is the close of the current candle plus whatever stop loss distance we are using times the stop loss take profit ratio. So this is the ratio that's going to define the difference between the stop loss and the take profit distances. Same thing for the take profit. In case we are shorting the market, it's the closing price minus the distance, stop loss distance, times the stop loss take profit ratio. So now we can print whatever we need here. So I'm printing the take profit for the buy and sell positions, and as well as the stop losses and the current candle, which is the last candle, just to make sure things are verified, that we have the correct numbers for all of these values before we open our trade on the market. So at this point, I can comment this line because this is a fake signal. I'm just forcing some trades on the market. So now we need to check if the signal, the true signal value provided by this function right here, a candle signal. If it's equal to 1, so this is a short signal or a bearish signal. So we're going to open a market order request on the Bitcoin US dollar. So this is a function provided by Oanda. Again, I'm going to go back here, and the market order request is something that we've imported from Oanda Python v20 contrib.requests. So we can use this function to open positions on the market. Unit is equal to -1. So because this is a shorting position, so it's negative and it's 1 Bitcoin. Take profit on fill is take profit details, and the price is equal to take profit sell.data. So this is how it's coded. This is the syntax. We just need to provide that the price is equal to take profit sell. And then the stop loss on fill, stop loss details, price is equal to stop loss sell.data. So we're passing the stop loss for selling positions and the take profit for selling positions here as parameters. Then orders.order create for the account ID that we've just defined before. The data is equal MO, whatever is defined here, the order. So market order dot data. And then the client.request, we're going to create a market order that's going to be fed into a order creation or a request, and that we're going to call the request function, providing the order that was created with all the details and the data. And that's it, basically. I'm printing RV just to make sure every time we have an order opened that we have some information on the screen. Same thing in the bullish signals. So if signals equal to 2, we're going to do exactly the same thing here, only this time the unit is equal to 1. Instead of a -1, it's going to be equal to +1. This is how Oanda would know this is a long position. We're using the take profit for the buying positions and the stop loss for the buying positions as well. And that's it. It's as easy and simple as this. This is our trading job. So whenever I call this function, it downloads data, it analyzes the signal, and if there is any valid signal, it's going to open a position on the market. We need to run this, if we're thinking about the daily time frame, we need to run this once a day, not more. It would be useless to run it more than once a day. So we're going to schedule this using a cron scheduler. Scheduler is equal to blocking scheduler, and this is, again, this is something imported here. So from APS scheduler, schedulers, blocking, import blocking scheduler. And that's what I'm using here to call this function one time every day, just before midnight. And the reason I'm choosing just before midnight, this is the time where the last candle, today's candle, is about to close. So we wouldn't have a lot of changes anymore, because anything here is related to the current candle, so the last candle. And remember that the last candle is today's candle, so it's still changing and it's not closed yet until midnight. Be aware of this, that you need to wait until the candle is well established, so you know that you can open your tester for signals so that your signals would be valid. You can't run the signal in the morning, for example at 5 a.m. because the candle is just opened for a few hours and you never know how the day will go. At the end of the day, you would have the, let's say, the final shape of today's candle because it's about to close within 5 minutes. And this is how we can have a valid signal. Of course, you have to translate this logic to any time frame you are trading. And that's it. We just have to define the scheduler, add the job, the function trading job, which is this big function here calling all the other functions, testing the signals and opening trades on the market, and scheduler.start, and you just leave this cell running. And as long as your PC is on and this cell is running, you are on the market, you're trading live, your bot is working. So again, I strongly advise you to test this live on a paper account for a few months before you deploy any strategy. This is not a strategy that has been intensely tested, so just be careful with whatever you took from this course. The information provided here has a priority purpose to educate and provide you with the knowledge, but then you need to test those strategies live on the market on different assets. Just make sure you're using a robust strategy before you think of deploying anything live using real money.
время, когда наш мир столкнулся с нечто. Ученые справедливости есть одно место. sv.bet. Более 150 тысяч курсов по самым разным направлениям по цене пары пинт эля в таверне. Вступайте в шервудскую банду прямо сейчас.